Hello, ladies and gentlemen. My name is Jim Edwards. I'm a tax practitioner in the Midwest in Iowa. I've been a tax practitioner for a little over 40 years. I've done over 15,000 tax returns personally during that period of time. I'm also a 20-year Navy man. I've had recently, at the urging of several of my clients, I have decided that I was going to do a little bit of a brief here on this Obamacare thing and how it's going to impact taxes. It's going to be very short. We're it's Saturday, November the 3rd. So we are about 3 days from what I believe to be the second most important date in the history of America. And we're going to go out and vote, and we're going to choose some new leadership. Well, what I wanted to do, again at the urging of some of my clients, I just wanted to give a brief overview of some of the things that are going to be impacted as a result of this Obamacare deal that's going on out there, that's being laid on us. As I go through the list, I've got it here. I'm just going to read some things from it. As I go through it, I want you to think about, please, I want you to think about November 6th of 2012. And then I want you to think about who laid this law on us and who's going to pay for it and how's it going to help job creation and how's it going to help you, how's it going to help your kids and your grandkids and your great-grandkids, and how's it going to help your country, how's it going to help your legacy. Think about those things, and maybe I'll remind you of that list again after I go through some of this. And then ask yourself, what can I do about this on November 6th, 2012. Now, what I've got here is again, as I said, I've got a list of some of these things. We had this Affordable Care Act became law back in March of 2010. What I'm going to do is I'm going to read some of the things here that it addresses. There are thousands of them, but I'm not going to read near all that. We're going to do about 8-10 minutes worth of this. And I'm going to tell you where it came from and just briefly what it says. And if you want to confirm it, go ahead. I encourage you to confirm it, actually, because we need to get more involved in what's going on around us. We're way too uninvolved. And maybe this will encourage us. It sure has me. First thing I want to tell you about is a new surtax on investment income that kicks in January of 2013. This is talked about in the PPACA Act on page 87 to 93. Talks about a new surtax of 3.8% on certain income, and this applies to people who have household incomes of more than $250,000, or if you're a single person, more than $200,000. Now, it may sound like quite a bit of money now, but believe me, it's not. In 2012, the capital gains rate is 15%. The dividend rate is 15%. In 2013, capital gains rate's going to 23.8% and 43.4% on dividends. Now, the kicker about this is there's also another aspect that's going to be hit here. In 2012, tax year 2012, if you have passive income from rental properties, from an S corporation, or from a partnership, this rate, the rate on those income items is going to be 35% if you fall within that AGI range of 250 or 200. And in 2013, it's going to 43.4%, again, for passive income from S corps and partnerships and rental property. This also covers annuities and interest and royalties as well. That's one. Another one is if anybody isn't buying a U.S. government standard qualified health insurance plan as of January of 2014, the Act on page 345 and 346 says that there's going to be a surtax charged against you, and this surtax is going to increase. It takes effect in January 2014, but it's going to increase in 2015 and 2016, and ultimately it will reach up to 2.5. The fine for not doing it will be 2.5% of your adjusted gross income, or $2,500, whichever is more. Now you can do the math on that and see how that affects you. Now, if your employer doesn't offer tax, health insurance, and you have to get it through one of the new exchanges that they've created, then the employer is going to pay $2,000 of non-deductible tax or surcharge for not having having purchased insurance for the employee. He's going to pay that for each employee, and if he's got 50 or more. Now, if the employee then uses the new exchange program to get his health insurance, the employer will then pay $3,000 for employee who goes and does that. Just think about the impact of this on jobs and job creation. Why would anybody want to have a big company? Well, I'm going to let you think about it. I'm not going to tell you what to think about it. Next thing is tax on medical device manufacturers, effective January, in about 6 weeks, 5-6 weeks. This is a 2.3% excise tax on the gross sales of devices by manufacturers of the devices. Now, what's that mean? Speaking of job creation, there are right now about 360,000 employees across 6,000 different plants in the United States of America that manufacture these things. Right now, there's already projected layoffs of 1,500 of those people in just 1913. Over the next 3 to 5 years, the people speaking for these organizations are saying there's going to be an additional 43,000 jobs that are going to be lost because of this ridiculous tax, this ridiculous excise tax. Again, it's 2.3% of the gross sales of these manufacturers. Ask me why manufacturing is going overseas. Now, increase in the medical expense cutoff. You know now that if your adjusted gross income is, whatever your adjusted gross income is, you may be able to deduct on your itemized deduction worksheet those expenses that exceed 7.5% of your adjusted gross income. Well, effective in January of 2013, in about 6 weeks, that is going to jump to 10% of your adjusted gross income. So if you've got $50,000 worth of adjusted gross income, you can't deduct a nickel of your medical expenses until they exceed $5,000. So 10% of your AGI effective January of 2013 and going forward. FSA accounts, flexible spending accounts, these starting in January of 2013, according to the Act on pages 2388 and 2389. Right now, FSA accounts are not limited, meaning that you can use your flexible spending account for medical expenses unlimitedly. But it's going to be capped at $2,500 effective January of 2013. And then it's going to be indexed for inflation. Now, this is particularly bad because this is, we heard earlier about special needs kids. Maybe here a few months ago they were addressing this issue and talking about special needs kids. And this is where the parents with special needs kids are going to be hit especially hard by this. Just reading recently where this can cost as much as $14,000 plus per year, the care of these kids in the Washington, D.C. area. But then they could use their flexible spending accounts effective 2013. They cannot do that anymore. Well, they can do it, but they only be able to deduct $2,500. The rest of it is going to have to be done some other way as far as flexible spending accounts go. There's something called a medical cabinet tax. This took effect back in January of 2011. So we've been living with this even if we didn't know it. And that's on page 1957 through 1959 of the Act. It's where this is covered. No longer can you use an HSA, an FSA, or an HRA program plan. You can't use monies from that, tax-free monies from that, to pay for over-the-counter medicines or non-prescription drugs. The one thing you can do it on it for is insulin, but nothing else can you do it for. That's taken out of the game. There's an HSA withdrawal tax hike that began back in 2011, in January of 2011. This was referred to and addressed at page 1959 of the Act. The early withdrawals from HSAs that are for non-medical reasons are going to jump from 10% to 20%. Now, what's going to happen with that? I think, is that people will start using their retirement accounts to, because you only have to pay 10% on the retirement account when you pull money out early on it. You can think about what the real objective there might be. There is a new excise tax that's going to kick in that did kick in January of 2010 on charitable hospitals. In the Act, this is found on page 1961 through 1971. The short of that is that if these charitable hospitals don't meet the billing and collection and financial assistance and community health assessment needs according to rules set down by the United States government, they will be fined $50,000 per hospital. These are charitable hospitals. Now, one other thing here is employer reporting of insurance on W-2s. Effective in January of 2012, as per the Act on page 1957, they have to, employers are supposed to put the amount of that health insurance on the W-2. Now, this is a precursor to employers identifying how much we pay for our health insurance, and it will be taxed. It will be taxed. This is a preamble to get that all set up, and our employers are going to be the ones who put that on on our W-2s, and on and on. Mr. Producer, how much time we got left? 1, 2 minutes? A couple minutes? Okay, I've got another list here that is several pages long that lists over and over and over and over, or not over and over, but many different kinds of taxes that we're going to be faced with. These include mandates that the government audit the books of all employers that are self-insured. The government is going to come in and audit the books according to this. By the way, the government is in the process of hiring 16,500 new compliance people to be able to execute these things. 16,500. Well, they're going to need a few. Let me look here and see here a couple of things. The Health Choices Commissioner will choose your health care benefits for you. This is page 42 of this new bill. You don't have a choice. What else here? I was going to make notes by these. The government's going to have direct access to your bank accounts for the elective funds transfers. So you're going to be needing to make these transfers as an employer electronically into these big organizational situations that are set up to deal with what we've got ahead of us. Ladies and gentlemen, I'm not going to go through the rest of this. I'm going to drop it right down on the floor where it belongs. But what I am going to say is, once again, who laid this law on us? Who's going to pay for it? How's it going to help in job creation? And how's it going to help you, your kids, your grandkids, your great-grandkids, your country, your legacy? And what can you do about it? November 6, 2012, the second most important day in the history of the United States of America. Great talking to you. Jim Edwards at the 1040company.com. I'm sorry, the 1040company at gmail.com. If you have any comments on this, would like to contact me. You'll be hearing more from me. Thank you.